as we all know, there's two trades that you can put together in the stock market, okay? You can buy first, sell later, okay? Simple. That's a trade. Two transactions, one trade. Or you can sell first, buy it back later at a cheaper price. So let me run this again. So one is a long position, long meaning you can buy first, sell later. You buy at 1, sell it at 2, you made 100% on your money. Cool. The next situation is there are people who short things. Shorting means they make money when things are going down. Okay. And this is public information. So how does the shorting strategy work, right? As I've said it a million times before. What did I say? Stocks walk up the stairs and take the express elevator down. That's what stocks do. And so my thing is, I do short stocks quite often when I see something that's shortable. Like, for example, I shorted the nuclear stocks last week and made a ton of money. However, shorting is very risky. Why is it risky? Because a stock's upside is unlimited. Downside is limited. If you short something, it can only go to zero. It's not going to go negative, right? And so there are short sellers in the market. And a lot of hedge funds, two-way hedge funds, long and short hedge funds, do short things. For example, when Apple went from 260 to 220, that's $40. If you shorted Apple, you made money. And a lot of people think it's counterintuitive. They go like, how do you sell something if you don't have it? Well, you borrow it. That's how you do it. But there is a thing called short interest ratio that I follow closely. And but over the last 2-3 years, in fact, since the pandemic or since the great financial crisis in 2008, shorting is not paying off. Why is that? Because the Fed is there with their hands like this saying there's a put in the market. Shorting is not working out for the short sellers, and it's pretty evident by these numbers. Are short sellers giving up? Short interest as a percentage of shares outstanding on the S&P 500 ETF has fallen to 8%, lowest in 7 years. That means nobody thinks market's going to go down. All the shorts have covered. All the shorts have closed their positions. We're down into 7-year lows. Well, this could be a counter indicator, actually. So you guys need to pay attention to that. And in the NASDAQ ETF triple Q, short interest has declined to 7%, also near the lowest since at least 2018. And here's the chart. Here's the NASDAQ, and here's the S&P 500, and here's going back to 2018. As you guys can see, these spikes happen, short interest spikes happen, because when the pandemic was going on, market took a dump of 40-50% almost in like a couple of months, right? That's when you make money. That's when stocks walk up the stairs or markets walk up the stairs and take the express elevator down. So by comparison, in 2018 to 2022, the average had been around 14%. So these two yellow lines is the average, but this is the current short. Well, if the shorts are giving up, okay, if the shorts are giving up, is the market in a healthy situation, right? I don't know. I don't think so, because I think the market is actually, personally speaking, this year my prediction is market's going to go up probably 6% overall, and it'll be a lot more volatile. So the fact that there's not enough shorts and market starts going down and the shorts come in and start pressing will add to the volatility. So if you're if you're thinking things are going to go nasty, shorting again presents wonderful opportunities, right? You can short indexes, you can short stocks, you can short calls, you can do all kinds of strategies to benefit from the downside. You can buy puts, right? Limited risk. And from what I'm seeing on the option market, to hedge your long portfolio, the put premiums are so low. They are so low that I think putting on hedges would be reasonably intelligent thing to do.